Welcome to No More, Risk Better, a CreditSights podcast. Across the global strategy team, we aim to make sense of the macro and the micro, highlighting opportunities and the risks facing the fixed income markets.
As the macro makes headlines, we leverage our network of experts across Fitch Solutions to better understand economic trends, rates gyrations, geopolitical events, and how these factors impact corporates.
At CreditSights, we understand that credit investing comes down to picking winners to generate alpha and avoiding losers. Our team of over 100 analysts across the US, Europe, and Asia provide unmatched sector expertise and fundamental knowledge.
In our weekly podcast, the strategy team offers a look at the conversations we have with our colleagues, including analysts, fellow strategists, economists, and leveraged finance market experts. If you want to know more so that you can risk better, you'll want to give this podcast a listen.
Hello, and thank you for tuning in to another episode of No More, Risk Better. I'm your host, Zach Griffiths, head of U.S. investment grade and macro strategy at CreditSights. And today I'm delighted to be joined again by BMI's chief economist, Cedric Chehab. Our loyal listeners will recognize him from several prior episodes. Cedric, thank you so much for coming back on the podcast.
Thanks for having me again. Really enjoy these chats.
All right, so we're going to be talking a bunch of topical items, some of them near-term in nature, some of them bigger picture, longer-term thematic items. And in terms of those short-term issues, Cedric, let's just start with what's going on in Iran, the latest in terms of the ceasefire supposedly being torn up, the matter of understanding being called into question, which frankly, it's been called into question many, many times over the past several weeks, pretty intensely over the past 2 days with the U.S. resuming attacks. And we are recording this July 9th morning, U.S. Eastern time. But Cedric, given the latest events, how are you and the team thinking about where we go from here?
Yeah, well, I think the path is much more unclear now than it was a couple of days ago when most people were optimistic, including ourselves. So the way we're seeing it is that the MOU was a testing phase, and we argued that there were two broad outcomes that could come from there. So first would be a tense but diplomatic solution, and we assigned about a 60% chance for that. And the second would be an escalation, which could either lead to a deal in the end, so a small escalation, or a significant re-escalation, which just scuppers the whole MOU altogether. And last week, it feels as if we were en route to the first diplomatic option, and now it seems as if we're veering off track. We could see either a temporary rise or a total scupper of the MOU entirely. Now, Trump did say the MOU is over, but maybe that was just to apply pressure, and he has said that negotiations can continue, so that's good. Other positive news is that Trump has managed to come back from the brink in the past, and considering the rise in oil prices and bond deals might encourage him to do so. And if you think about some of the attacks, although they were quite aggressive by the U.S., it seems as if there was a large concentration near the Strait of Hormuz, so it's kind of very strategic there. And then the Iranian side didn't seem to, it attacked back, but its retaliation wasn't as strong, which could be interpreted potentially as a form of escalatory de-escalation. So we haven't changed our view altogether, but it's certainly much bigger risk now that things go pear-shaped.
Yeah, so what are you watching to assess how this goes going forward? I mean, to me, the whole idea of a ceasefire or matter of understanding, while we have continued to strike one another, makes no sense. But perhaps in historical context, this is just how these negotiations go. And when it's written in history, you kind of paper over this period of uncertainty and kind of small skirmishes. But setting that aside, what are you watching most intently to get a gauge of what really might be a durable solution or non-solution?
Yeah, so what you said about kind of the ceasefire is quite interesting because this is quite volatile in terms of continued attacks, and it seems as if Iran and the US have been tolerant of a few attacks here and there. So that was quite interesting a few weeks ago. But I think what we're looking for now is whether the escalation increases to the point that vessels just stop crossing the strait, because that will determine oil prices. And if you remember a few weeks ago, markets were very quick to price in much lower oil prices on expectations that the strait would reopen. So they moved ahead of the data around vessels, actually. And we think this is why oil has jumped back up closer to 80, as it's now being repriced. That risk is now being repriced into oil markets.
And so in terms of a more durable escalation, what does that look like from your seat?
Yeah, for the MOU to kind of fall apart, I think we need to see an increase in intensity of the attacks on military and non-military targets, which then provokes escalated responses on both sides, a blockade of Iranian oil by the US, and I think Iranian efforts to fully close the strait again. I think that would be a kind of line in the sand, which we would then look and say, this is really bad.
And so none of that's happened yet. We've seen oil prices rise, but admittedly, really back to the pre-war levels. And if you want to say, well, there was already a war premium priced in by the time we got to the end of February, maybe $60 is truly the pre-war, pre-pricing in of war risk premium, then we didn't get all the way back there, but we're seeing things rise. Zooming out even more broadly, maybe assuming oil prices stay stuck where they are now, what does this mean for the global economy and markets from your perspective?
I mean, at this point, it's kind of a wait and see, because oil prices are a little bit higher than we thought they would, but not too damaging for the global economy, right? But I think if you do see a more significant and sustained escalation of prices, then that becomes quite painful for the economy through three major channels. So the first one is higher oil prices, of course, inflation and inflation expectations. In response, that would probably see a very sharp tightening of global financial conditions. So that's rising bond yields, maybe a stronger dollar, more central banks raising interest rates. And then third, you have a negative wealth effect, both in terms of equity markets falling, but also rising oil prices, which saps consumer purchasing power. And the concern there is, if there is a large escalation in oil prices, then this is the second major energy shock in several months. And that would probably lead to a larger rise in inflation expectations, which actually have been relatively well anchored, recently on kind of greater optimism that Trump and Iran would get to a deal. And that would lead to probably another round of monetary tightening across the world. And these dynamics could see a non-linear impact on the global growth picture compared to the somewhat limited impact that we've seen over the past 2 or 3 months. So I think that worries me if we start to get a second big kind of shock, which leads to a sharp rise in inflation expectations and then a non-linear impact on the economy.
Yeah, I think those transmission channels are really interesting to consider, especially in the context of higher bond yields and a stronger dollar, which I think we've had relative to expectations coming into this year. And on the inflation expectation side, I think, frankly, they've been incredibly well behaved and are pretty incredibly low across the curve right now. If you look at tips, I think around 2.3% across the curve, give or take. I mean, those levels might be a day or two old now, and things are swinging around. But thinking about all of the risk out there, to think of, a relatively flat inflation expectation curve right around the Fed's target, that's a pretty incredible backdrop. How are you thinking about the dollar? So I think we can get into all of those topics individually. I know that you wrote a piece back in early June highlighting potential upside on the dollar. Things have swung around a bit. I think it's been a good call. We certainly have appreciated at least a bit since then. But what do you think kind of drove the recent rise in the dollar? And I think you highlighted a potential upside risk of 5 to 10% from around a level of 99.2, let's say, on the DXY. What do you think we need to see to get to that 5 to 10% appreciation range?
So I think there are kind of two broad drivers. So the first one is, if you look at the aggregate kind of things like fundamentals, technicals, and whatnot. And then the second one is more just interest rate expectations, which shifted. And the argument I made in early June was that there are a few things which are lining up, which suggest maybe the dollar could have a bigger move to the upside. And this is within the context that a lot of analysts were still kind of somewhat downbeat on the dollar. So it was a bit of a contrarian view. So the kind of things we were looking at were the technicals, where the dollar looked like it was breaking higher, momentum indicators were turning up, and investor positioning looked like they could head higher, right? Then you have, from a fundamental perspective, the US economy seems to be doing better than peers. Current fiscal account deficits seem to be better. They're narrowing. Earnings are really strong. There's good yield on offer. And in terms of valuations, the dollar's less overvalued than it was 12 months ago, and that potentially opens up some space for a rally. And the other thing to look at whenever I look at the dollars, I try to look at the other side of the coin, which is what are the FX pairs doing? And I thought, well, the euro looks a little bit sensitive to this oil shock because the Eurozone economy is more vulnerable in terms of the pass-through. In Japan, under Takeichi, you have bigger deficits, a slightly more dovish BOJ going forward. And then in terms of the Chinese yuan, for example, it's appreciated by about 8% over the past kind of since early 2025. So there's limits to that appreciation. So I just thought the balance of risks were more to the upside. But back to my first point, what I think really moved the needle over the near term was that the more hawkish repricing of US interest rates really moved the dollar index because they were kind of moving in lockstep. So I think it was that. And that's why when you saw the hawkish repricing become a little bit more dovish, then the dollar came off a bit.
Well, I think that's a great place to go next. I have a chart looking at SOFR futures comparing the curve today to February 27th and year-end 2025. And it's a pretty wild move from those prior two levels to what it looks like today with rate hikes priced in the near term and the policy rate kind of settling in around 4% on a sustained basis through even 2028 is what the market prices today, or at least it did yesterday. How does that compare to your Fed view? Are you buying this repricing to hikes in the near term and higher rates in general, longer term?
So I think right now, because of oil prices and relatively strong growth, I think the market is reflecting that concern. Also, we had the Fed, which was a little bit more hawkish in its statements and the summary of economic projections or the dot plot, for example. We think they'll remain on hold, right? They have a dual mandate. Inflation is kind of mostly being driven by the supply side factors, and most of the FOMC expect inflation was going to ease later this year, at least in their June meeting. And at the same time, although the labor market's a little bit less volatile, it's not that strong. So we think the balance of risks are not yet too much to either either on the inflation side or on the labor market side. So might as well just stay put for a bit as long as inflation expectations remain anchored, and then take some time to make a decision later. And so for that reason, we think that the Fed just remains on hold this year. Going into next year, we still have a bias towards a cut or two.
I'd say we're well aligned. We're certainly expecting the Fed to be on hold through the end of 2026, maybe even through the first half of 2027. I certainly take your point on the labor market. We had come into this year expecting it to weaken further. It's stabilized, but I agree, it doesn't seem super healthy, especially when you think about the labor force participation rate at a 5-year low. And if you look at the number of unemployed persons in the household survey, which feeds into the unemployment rate, that number is lower in aggregate than it was to start the year, while on the establishment survey side, which is the most widely quoted job gains number, those have actually been quite a bit more robust than what we saw in 2025 as a whole. So I think there's definitely good reason to expect the Fed to be on hold and maybe a little bit more balanced to the risks to its dual mandate relative to the end of 2025 when they seem much more focused on a weakening labor market. And so I think you kind of gave us a little bit of a window there, but maybe just flush out your view on inflation, a little more on the balance of risk between the labor market and inflation going forward, and maybe how that fits into your overall economic growth view for the U.S.
Okay, sure. So just before I do that, I just want to mention that there is a natural tension in the design of the Fed's dual mandate, right? And this tension is most evident during energy type or other types of supply shocks. So for example, on the one hand, you have higher inflation, which would require, let's say, policy to tighten. Yet a supply shock can also lead to weaker labor markets, which would require policy to loosen. So you can see that tension exists, and we're kind of potentially facing it now. And as much as people criticize Jay Powell and the FOMC, and I think somewhat fairly, for being too slow to hike rates back when inflation really started to ramp up, when the FOMC finally did hike, and they hiked quite aggressively, most people assumed that the US economy, and they were forecasting that it would fall into recession. And what that highlights essentially is both the tension that exists in the dual mandate, which makes it so difficult, as well as the fact that the FOMC was willing to sink the economy if it meant getting inflation down. And so I think that's a framing that some people forget to think about, which I think is very important. Now, if we fast forward to where we are now, I would say up until a few days ago, we were confident that prices would converge closer to the mid to low threes by year end, even if there's going to be maybe some additional consumer electronics and AI related inflation, which was adding more pressure. At the same time, we thought that there was going to be some stability in the labor markets. And because of that, we thought actually the Fed doesn't need to do anything and can just wait and see. But this kind of dynamic changes, or this equilibrium changes substantially given the risk of an escalation that we just spoke about kind of a few minutes ago. If oil prices were to rise sharply, maybe above 100 or so, we see an increase in inflation expectations, which have been well anchored thus far, right? Then the Fed would likely have to bite the bullet and hike once or twice, at which point the labor market would probably crack.
Yeah, a lot of interesting points there, Cedric. I just went back and looked at the Fed's own projections at the end of 2022, and they had growth falling to 0.5% in 2023. So by 2022, they had probably already done about 175 basis points in hike. So the Fed itself never expected to dip the economy into recession, but it was willing to slow it meaningfully, which actually never happened. And I think that also gets to another point. We could probably have a whole podcast on this, thinking about how monetary policy is transmitted through the economy different today than it has, in many past periods, and perhaps the combination of super low rates in response to COVID, followed by a rapid rising in some of the housing market dynamics, which I think we'll get into in a little bit, how that kind of shifted plays a role as well. So in terms of the labor market more specifically, do you think that has stabilized? And, are we able to continue this soft landing that's effectively been in place for several years now? Or do you think that some of these underlying weaknesses that you've highlighted and we've discussed so far are likely to give way to an even weaker environment going forward?
I think as long as inflation and oil prices remain near current levels, a little bit lower, I think we're okay. So in January, we were definitely more concerned about the labor market, but since then it feels as if it stabilized a little bit. There are areas of weakness, but it feels as a little bit better. So for example, cyclical components like construction's looking a little bit better. The ISM employment readings look a little bit stronger, with services back in positive territory. For example, above 50. Weekly hours worked is pretty stable. Layoffs are stable as well. Jobless claims look okay. The initial jobless claims on a weekly basis, but
Unbelievably stable. Yeah.
But as you pointed out, there are some areas of weakness, right? So some of that hiring could have been done in advance of the World Cup. We saw kind of a pop in leisure, for example. The monthly numbers remain very erratic, subject to big revisions, which is always problematic. Surveys from kind of the employee side say that it's fine to find a job, and kind of they're scarce. And then the other thing, more from the consumer perspective, is actually real wage growth is negative, because you have nominal wages, which is slowing to about 3.4%, and then you have inflation at about 4.2%. So in real terms, it's negative. So it's not as if it's in a great place, but it's not terrible either.
And so even with all of these moving pieces on the geopolitics front, it seems like as long as the strait doesn't close again, BMI's outlook for economic growth is fine. I think it's around 2.1%. So a decently sanguine backdrop. But I think there are plenty of risks. There's certainly plenty of risks from our perspective. What are the key risks to the outlook as you see them, Cedric?
Yeah, so let me just walk you through some of the kind of more positive things, and I'll talk about the risks, if that's okay.
Sounds great.
Okay, so we forecast growth of around 2%, as you said, 2%, and that's around trend growth. So it's not bad at all. And, by any measure, it's a little bit slower than last year, but not bad by any measure. I'd say when you look at different parts of the economy, the fiscal story looks a little bit better than what most people were expecting last year. Exports are also quite strong. The current account deficit on a quarterly basis has shrunk quite a bit. And that's partly due to energy exports, but you've had really strong exports of semiconductors as well. We know that AI investment is really strong, contributing about 1.3 percentage points to growth. And then government spending is picked up after the government shutdown late last year. And then so we had strong Q1 numbers. And one thing I like to always remind people of is, of course, you have the kind of high frequency cyclical stuff, but Trump policies that he's been implementing since early 2025 are quite redistributive, and they redistribute income basically from kind of the global economy towards the US economy and towards the US. And this happens in a few ways. So the first one is that, remember, those trade deals came with commitments to buy more US exports and reduce kind of trade barriers. And they also came with commitments to invest much more in the US. And we're probably seeing some of that investment start to flow through. Now, Trump says it's $19 trillion. Of course, it's not $19 trillion, but it's not nothing either, right? And when you, like, Toyota just, I think, announced a massive plant. I was talking to the autos teams, and since, I think, mid last year, there's something like $13-14 billion of commitments in the auto sector or supply chain autos. So we are seeing some investment coming in. The second thing is, Trump has gone around the world basically telling NATO, you got to spend more, and everybody's spending more. I think the latest number is quite a few tens of billions. And that spending actually favors U.S. military procurement and exports because they're buying a lot of U.S. missiles, a lot of U.S. military goods. So in that regard, there's this kind of continuous redistribution that Trump has engineered. And then if you remember, the dollar is still weaker from pre-Trump days. And that also helps support some of the trade dynamics. So in that regard, I think that there's some underlying factors which might be helping the U.S. economy from a kind of global redistribution perspective that we sometimes forget about, but are probably a little bit in the background. And, policies of deregulation, tax cuts, etc., are also kind of favorable. But as you alluded to, it's not all roses. And of course, we definitely see risks. So the housing market, I don't feel it's a huge risk, but it's definitely stuck in the sense that interest rates are just not coming down quickly enough. And the 30-year mortgage, for example, that's still around 6.5. It's just too high probably for the market to clear properly. Starts and permits have basically gone nowhere. They've gone sideways for 4 years. They're quite low. And I think the latest numbers showed that the starts took another leg lower. So the housing market is really important for the economy, and it's just kind of not really doing much. And I think unless it picks up, and if things turn pear-shaped or things don't look good, then the housing market just kind of weakens further. But I think the probably more important cyclical risk that a lot of people are thinking about is AI, both in terms of how much investment is coming in and how much of growth is being driven by AI. So I mentioned about 1.3 percentage points of growth is kind of AI related, kind of software and kind of information processing investment. And
Cedric, how do you get to that? Do you just use those 2 or 3 lines in the national accounts, or do you have are there any kind of knock-on effects that you think that you try to incorporate that wouldn't necessarily show up in the line-by-line data?
We look at the line-by-line data because it's a good way to, it's a clean way to look at it. But you can also look at it through other ways. So you can look at kind of construction of kind of data center type related investments, but it's not exactly comparable. So you would look at it in a clean way, but then you kind of triangulate it with other data as well. That's probably the best way to do it. So as I was saying, AI, it feels a bit like we're in a bubble. It's just not clear where we are in the bubble. So I like to look at the kind of historical comparisons, and obviously it's no two periods are the same, but the NASDAQ hasn't gone vertical like in the 1990s. So people may say, well, that's not a bubble. Profitability seems to be a bit better. So maybe people say that's not a bubble. The S&P market cap of 200%, however, is really high. And it's almost double what we saw in the late 90s, early 2000s. So people point to that and say, look, I think that's, they reference kind of that's Warren Buffett's kind of favorite indicator, market cap to GDP. But if the US economy, if US companies are basically global companies extracting revenues from the whole world, and the US economy now is only about 24% of global GDP, whereas maybe 20, 30 years ago was closer to 30%, then maybe the market cap should be higher. But, you look at the chart and it still looks like it shouldn't be so high, right? Then
Wait, that's today? The S&P 500 market cap is 200% of GDP? That's not the 90s?
I think it's close to that, yeah.
Wow.
I think it's close to that. That's the numbers I was seeing. And then AI-related investment has risen from about 4.5% of GDP to 5.5% of GDP in the past few years. And sometimes, when you have one sector rising as a share of GDP, that raises kind of warning and alarm bells. Now, obviously, if you compare it to real estate in the kind of 2002 to 2006 period, real estate rose much quickly, and real estate is a kind of lower productivity type of investment. But you could argue that it's happening very quickly, and maybe AI is it's not going to be what people think it's going to be, right? A lot of people are saying the LLMs, while very good, they're actually not as good as what's being promised, or the amount of money, the returns or profitability is not going to match how much commitment, how much invested capital they've made. So in that sense, I think there are lots of questions. There are also a lot of questions around margin debt, free cash flow, circular financing, valuation. So, you can look at this, and if you're an optimist, you'll say, well, there are lots of things which could be positive. If you're a pessimist, you get point out lots of things, right? And as my old boss used to say, it takes two to make a market.
Yeah, absolutely. And so I think the other thing that you've brought up in a few of our meetings is kind of the use of margin debt and rising leverage in the stock market. And I think that another way to look at that is the growing prominence of, I think there's single stock levered ETFs or just levered ETFs in general. When you think about some of the analysis you've done there and compare it to overall household debt to GDP metrics, other consumer and even corporate commercial balance sheet metrics, is it kind of at the margin, or is it really at a concerning level from your perspective when you try to take it all together? I know that when you look at household debt to GDP, it's nothing like it was in the mid 2000s, and so I think that gives people some comfort. But where you have seen debt to GDP grow meaningfully is on the government side. But kind of thinking about this use of margin debt and potentially leverage in the stock market, how does that fit into your balance of risks?
So that's definitely very risky, because if you have a lot of people taking large margin positions, then if the market falls 10%, 15%, they can get wiped out altogether, right? And that creates a negative wealth effect. The good thing is, as you mentioned, the general household balance sheet is really strong, right? So coming out of the financial crisis, the great financial crisis, I think consumer debt or household debt was close to 100% of GDP. Now it's currently closer to 68 or so. So balance sheets are good. The asset side is also very strong, but it's also very skewed in the US. And that's, people are talking about the K-shaped recovery, etc. And so household wealth is concentrated. And so I think that also leaves, while the aggregate numbers look okay, in terms of kind of consumer debt, when you look at the margin numbers and then you look at some reports from the Fed, for example, that say actually lower income groups are struggling to pay their bills and they're relying more on kind of taking on a bit of credit and whatnot, you can see that the fundamentals at a more micro level are not so good. And so when you have a negative wealth effect margin debt, which kind of reverses, I think it could be quite painful. And then to your point about leveraged ETFs, like they cause a lot of volatility in the market, because the people who run the ETFs almost have to chase the market on the upside and downside, and apparently it leads to larger moves than they would otherwise think.
All right, so central to the stock market consideration is certainly the AI bubble consideration. I think you made plenty of arguments to say we're not in a bubble, or perhaps we're not in a bubble at peak size. And I think the way that I've been trying to grapple with this risk is coming into this year, we thought that all the debt financing, moving from free cash flow financed investments by the hyperscalers to debt finance, would become an overhang for credit spreads. So far, they haven't. The most recent Amazon deal seems to be causing some consternation. But in general, through the first half of the year, we've priced over 1.2 trillion in U.S. IG corporates, no problem. We were a little more concerned about the return on investment consideration that you had just mentioned in terms of all this cash being spent, how much of it actually generates a reasonable return on investment. That's kind of out there, but doesn't seem to be top of mind for investors. And so when you think about the balance of risks, or, the size of the AI bubble, do you think it bursting is a concern in the next 12 months, or is it more like a 3 to 5 year concern based on the analysis you've done?
That's a really tough one. Thanks for putting me on the spot. So look, the point of bubbles is it's really hard to know when they peak, right? To your point, you mentioned kind of a lot of IG debt issuance. Same thing on the equity side, right? You have a lot of supply as these mega IPOs come to market at a time when these large tech companies are just getting, their free cash flow is kind of going to zero. And so they're not buying back as much stock. And so you also have a supply demand imbalance in the equity market. And I think that might get even worse in 2027 as a lot of that unlocked stock or the locked up stock in these major IPOs get unlocked. So I think that's similar to what you might be talking about in the kind of IG market. But going back to your original question, look, there's a good quote, which I like, goes something like this, which is every bear market starts with a 10% correction, but not all 10% corrections or so end up being a bear market, right? And so, you can get false signals. There are people who've called the past 30 bear markets, for example, which never happened. So I'm a bit reticent to say I think we're in a bubble that's going to pop in 1 year or 2 years. I think you have to wait and see closer. But I would say, go ahead.
I was going to say 30 out of the past 5 bear markets
exactly
have been predicted, right?
Exactly.
Yeah.
And the point is, like, if you look at certain segments, like the memory chips and whatnot, they've gone vertical. It's absolutely bananas, right? So you'd say, okay, it's in the bubble, continue to go higher. So it's just one of those very strange things. So, but the point is, if someone walks in, it's like if you look at this and you look at some of these charts, you think, wow, this is really worrying, market cap, things like that, right? So that's why I said I think we are in a bubble. It's just hard to know exactly where in the bubble we are.
All right, so we've covered a lot of topical items and somehow have managed to avoid the midterms and politics for the most part up to this point. But I want to get your view, what you're thinking about in terms of the outcome of the midterms and what it means for markets and the economy. For me personally, and kind of our view on the CreditSights side, is that while the outcome of the midterm election is probably not all that important in terms of near-term policy changes, if we shift to a divided government, then it seems very unlikely of big sweeping legislation, although President Trump has ruled mostly by executive order. They have gotten through, obviously, some large bills through the budget reconciliation process. If they lose control of both chambers of Congress, that's kind of off the table. But if you were to see a huge victory by the Democrats, and I think that's what would cause perhaps a repricing of expectations in terms of what happens in 2028, and shifting from this very business-friendly backdrop, as you mentioned at the outset, tax cuts, other tax provisions, and the deregulatory backdrop, swinging bigly, to use one of Trump's words, in the other direction. I think that's a risk, and that's maybe more of an extrapolation of the midterm elections relative to kind of a political reality of election outcomes. So I said probably more than is necessary when asking a question, but what is your view on the midterms and how politics are likely to shape up over the next few months?
So it's very unlikely that the Republicans are able to maintain the House. So Democrats are likely to flip it, but that's really not unusual. And there's one argument which says actually, if you have a bit of deadlock, no one can do harm to the economy, So, but I do think there's some important considerations. So you might have the debt ceiling negotiations, 2027, which could be, made more difficult if Democrats have a very strong position and negotiate really hard. At the same time, you mentioned it makes 2028 a little bit more uncertain, and to the degree that we've seen a little bit of a wave of more kind of, was it democratic socialists and much more socialist type policies, I think that might concern investors. But you mentioned that Trump's policies were very business friendly. I agree, but they also caused huge amounts of uncertainty. And so Trump by nature is volatile and creates huge amounts of uncertainty. And that is very painful for the private sector as well. So I just wanted to mention that. The other thing is that midterm years are actually, and going back to the equity question, right? Midterm years are actually a lot more volatile years for the equity markets with larger than normal drawdowns, right? And we did some analysis a few weeks ago, actually, that suggested that we're starting to see more frequent, very large corrections. So, for example, we've corrections of 18% and larger have become more frequent. So since 2018, the S&P has recorded 4 declines of more than 18% over an 8-year period, right? And one of them, of course, is COVID. Now, this compares with only 5 periods, 5 corrections of larger than 18% over 17 years between 1990 and 2007. Now, of course, 2 of those were pretty big bear markets in 2000, 2007. But it just feels as if the frequency of these large corrections has picked up. And political risk, I think, would certainly be one of the drivers.
That's really interesting because I would not think that. I feel like with the amount of uncertainty that Trump has injected in terms of his policymaking style, let's call it, I'd say the market has been extremely resilient in the face of some of that. Even some of the biggest moves, whether it be Liberation Day in 2025 or with the war this year. But I think zooming out and providing that, longer run perspective is very interesting.
Well, you also had crazy good returns, right, over that period. So it's kind of giving some of that back. So I have to put that into context as well.
Yeah. All right. We covered a lot here, Cedric. Is there anything we missed in terms of what's top of mind from your seat as chief economist at BMI?
Yeah, I'd say just one last thing. So one of the themes we've been talking about is regime change, and this is across different things like geopolitics, domestic politics, trade dynamics, monetary system, technology, demographics. And we've been really focused on kind of thinking about how to quantify political risk, because geopolitical risk and political risk is very hard to quantify. And we've been working very hard to do that. And our clients can basically, we've been using this kind of quantitative tools to basically look at political risk, 30 indicators across political risk for about 140 countries. And that has been helping us to think about who's going to win which election from the election model, how bilateral tensions are rising between 2 different nations, for example. And you can see that because it's such high frequency data, it's actually in some ways very correlated to markets. And so we think that, we've seen a big shift towards a focus on political risk, a geopolitical risk. We think that's only going to get stronger and stronger.
Yeah, that's a great point and interesting. I'll have to dig into some of that data myself. I'd love to check it out and see how well correlated it is to markets, and more importantly, how well it can predict election outcomes and the corresponding market moves. All right, Cedric, that was a great discussion. As always, thank you so much for coming back on No More Risk Better.
Thanks for having me, and look forward to the next time.
And thank you all for tuning in. Best of luck out there.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.